Okay.
Okay, fine. Welcome to the session. So here is your Pushpushri ma'am, and today I will be going on with your HP. So in the last session, we have completed a few parts regarding an HP. We have completed the few of our theory parts, and the remaining I'll be doing on today. Today I'll go with some of the deductions. So that is your deductions under section 24. So under the section 24, we have a certain deduction. About those deduction, we'll just see it today. So in this deduction under your section 24, we are again having the different kinds of deductions, that how we are going to give an deduction. So in that, the very first one we study here is our standard deduction. So your standard deduction will be coming under your section 24 subsection A. So section 24 subsection A will tell about the standard deduction. So what is the standard deduction in the case of HB? So in the case of HB, the standard deduction is 30% of net annual value. So whatever your net annual value is there, on that 30%, here we give it as a standard deduction, and it is the standard amount. So irrespective of change in anything, so this will never change. So you have to know this. And based on the actual expenditure occurred, on this actual expenditure, we will be charging this amount over here. So coming on to this, 30% of NAV is allowed. NAV is allowed as standard or flat deduction, standard or flat deduction, irrespective of the actual expenditure method. Irrespective of the actual expenditure method. So irrespective of any of your actual expenditure method, we will be using our standard deduction here, and standard deduction is always 30%. You have to remember this number, the 30%. You should not get confused with your standard deduction anytime. And apart from our standard deduction, we do have interest, that is on interest on borrowed capital. You have borrowed some capital. On that borrowed capital, you are paying an interest. So that comes under your section 24 subsection B. So what is this interest on borrowed capital will be telling us? So here interest payable, on the here you have to pay the interest. So you can take down interest payable, interest payable on the loan borrowed, on the loan borrowed for the purpose of acquisition. So here you may take the loan that for the purpose of acquisition. For the purpose of acquisition is nothing but you have to purchase something or you have to acquire something, and for that purpose you may borrow the loan, or you may borrow the loan for the purpose of construction. You wanted to construct something, and for the purpose of construction you may borrow the loan, or for the re-innovation, for re-innovating something you may borrow the loan. So that is something but an re-innovation. Or you may borrow the loan on the basis of a repairs. You wanted to do some repairs or any kind of reconstruction, where that all these things comes under a deduction only. So all this can be allowed as a deduction under the interest borrowed on the capital. And in the second situation here, we usually claim this, that you can take the point like it can be claimed on, it can be claimed on accrual basis. You might have studied about accrual interest or accrual basis. You can always claim like an EMIs on an installments. You can claim whatever the capital that you have borrowed, the interest you can claim on that amount on an accrual basis. And also interest relating to the year of completion, you can take down interest related to the year of completion Year of completion of construction can be fully, of construction can be fully claimed in that year, irrespective of the date of completion. In that year, irrespective of date of completion. Irrespective of the date of completion, you don't worry about the date of completion, but still, whatever the interest that has been related to a particular year, so that is especially for the construction purpose, you can fully claim that. Okay, so that is still the year of completion. You can claim your interest and you can also pay the amount that you have been borrowed over here. So any doubts in this? Okay. So hope you people have understood. Now I'll go with the next part. Yeah, the continuation part. In this concept, that is in the interest on borrowed capital, we get a very major or the very important point. Usually your problem sometimes will be based on this. So then what is that? I'll just tell you, see here. So that is nothing but your interest for pre-construction. Interest for pre-construction period. So pre-construction period, still you have not constructed it, but still you'll be paying the interest for that pre-construction period. So usually in this situation, interest payable, whatever that interest that you're going to pay during this construction period, so what we call that as a pre-construction period. And whatever interest that you people are going to pay or you are going to make on this accumulated or any kind of deduction that you are going to make on this claimed amount, so that usually for the 5 years, okay, 5 years that you usually do it in equal installment. In 5 equal installments, you're going to pay back that amount. So in 5 equal installments. And also you do commence your year of completion of construction, that's after your 5 years. So this is what we call it as a interest for pre-construction period. So usually that will be given for the 5 years. So where you will be paying that in the equal installments. So that's all this point is. So next heading, that is under this only we have a next heading, that is what we call it as self-occupied property. Self-occupied property or unoccupied property section. So this comes under your section 23 subsection 2. So what does this section will tell you? What is self-occupied property or what is unoccupied property? So coming on to a self-occupied property or unoccupied property, if you're occupied in that property is what we call it as a self-occupied property. Suppose this is my property. So in this property, I have been occupied these many parts. Okay, so I'm staying in this part. Okay, this is an actual, the whole property. In this property, I'm staying over here. So that is a self-occupied property. This property is empty still. Nobody has occupied. That is what we call it as a unoccupied property. So this is what the major difference between your self-occupied property and unoccupied property. So under this also we have a certain situation. So we'll just see that here also the local authority will be having a standard deductions. So that is 30% of MAV. So the same, this is standard deduction 30%. Everywhere we consider this. So you have to remember this 30%. And apart from this, if you are borrowing any interest, so even this point is important. Interest on loan borrowed. Interest on loan borrowed shall not exceed rupees 30,000. Shall not exceed rupees 30,000. That means if you're taking the interest, if you're taking a loan on that, the interest, whatever you're going to give, so that will not increase more than 30,000. It will be below than that only. And further to this, the amount of deduction,
so will not exceed. Okay, if you are doing any kind of deduction under this situation, the deduction you can take down, deduction shall exceed, amount of deduction shall exceed rupees 2 lakh. So it may exceed 2 lakh or it may not exceed, but here the reduction will be exceeding 2 lakh. Suppose if you are doing, or further if you are providing any of the following conditions, I'll tell you what are the following condition. If that has been satisfied, then the amount of deduction will be 2 lakh. So then what are all those kind of conditions? So we'll see that conditions one by one. So here is my first condition, whether or if the property is acquired or constructed, is acquired or constructed with loan borrowed, with loan borrowed on or after the 1/4/2000, on 1/4/1999. And okay, this is the first situation where, so have a look to the first situation. So the first situation is, suppose if you are acquiring the property or the construction, if you are taking on any kind of loan that you are taking on any of the property, if you are taking after 1/4/1919, and that means it will exceed 2 lakh only in these two situations. The second point, such acquisition or construction, such acquisition or construction, such acquisition or construction is completed within 5 years. Is completed within 5 years. That means if you're taking a loan or if you're acquiring something, if you're constructing something, you're going to complete that within the time period of 5 years. That is from the end of financial year that you're going to borrow the loan. Okay, so you can take down that also, from the end of the financial year in which the loan was borrowed. Financial year in which the loan was borrowed. Okay, so this is what the two conditions will tell you. So this is your first condition, this is your second condition. So I hope you understood with the two of your conditions. So now I'll go with the next point. So have a look to your next points. So the same part, the continued one. So here, this is again, whatever I tell you now, people, it's again an important one. Suppose if the loan is borrowed for the purpose of, suppose if you are taking any loans that is for repairing or for renovating or for reconstruction, then we do also give some of the maximum deduction. So maximum deduction, if it is a self-occupied property, we give 30,000. So irrespective of this 1/4/1999, irrespective of the date, we give the standard deduction. Apart from this, the limit will be up to, starts from 30,000 to 2 lakh again. So that is up for a single particular person. And in that also 1/5 will be an accumulated interest, what he'll be getting for the pre-construction period, that too especially for the self-occupied property. Okay, so that's what, again, I'll give you the notes regarding that. So suppose if the loan is borrowed for the purpose of, if the loan is borrowed for the purpose of repairs, renovation, or reconstruction, then the maximum deduction for, then the maximum deduction for self-occupied property is self-occupied property is rupees 30,000 irrespective of date of loan. Okay, this is the first thing you have to know. And again, you have to take down the one more important point. They might ask you in MCQ. The limit of rupees 30,000, or I'll write it as 30K, 30,000, or rupees 2 lakh is per person, and shall be including 1/5 of the accumulated interest, 1/5 of the accumulated interest of pre-construction period or self-occupied property, Okay, these are the two important points. They might ask you in an exam, so you have to know these 2 points carefully. So apart from this, we have deemed to be let out property. Sometimes we call the property as deemed to be an let out property. If a property is deemed to be a let out property, even in that we have a certain situation, even we have a certain crisis, how do we treat that deemed to be a let out property? So I think before going on to that, I'll just change my screen. I hope you people have understood this. So now let me clear your screen. Okay, so now we'll go with our next concept. The next concept will be deemed to be let out property. Deemed to be let out property. Deemed to be a let out property is nothing but forcefully you're making the property to be a let out property. Okay, so this usually comes under your section 23 subsection 4. So what is deemed to be a let out property will be usually telling you over here. So suppose if I'm an assessee, if I'm paying the tax, and if I've occupied more than 2 houses, just because I need to have some residence that is for myself and as well as for some of my family members, and I'm not letting it the family members for paying of rent, they're using it free of cost. And at this option, what happens, being as a SSC, for me, I have to make a choice between these 2 houses where only as a self-occupied houses. That means I'll be treating these 2 houses as a self-occupied houses only. So others, if they're going to self-occupy these kind of houses, usually we are going to treat it as a let out property, or any kind of annual value will be usually determined in this kind of let out property and all. But the major benefit over here is your annual value will be nil here. Okay, your annual value will be nil, that too irrespective of, if suppose if you're having 2 self-occupied house of properties, that is usually available only for individual or HUF, that is not for the businessman or any kind of business person. Okay, you have to know this point very carefully. So about this point only I'll be telling you now. So you have to take down the point, the first one below this, where an assessee has occupied more than 2 houses, more than two houses for the purpose of residence or for the purpose of for the just a minute. Yeah, for the purpose of residence or for himself and family members, or for himself and family members, and not let it out for rent, and not let it out for rent, comma, then at the option of assessee, then at the option of assessee, he has to make a choice of two houses only. He has to make a choice of two houses only, okay, as self-occupied houses, as self-occupied houses. Okay, so that's what the same thing I said. You suppose if others are going to occupy your self-occupied houses, we usually treat that where it is let out, and also the annual value here we are going to determine here based on the manner, like how much property they have been let out. And in the same way, the main benefit over here is your annual value will be nil, just because irrespective of these two houses, if it is a self-occupied house property, usually we are going to give this only for individual or HUF, okay? And to compute our income from deemed to be let out property, you are having a certain modifications. So what are all those modifications? I will be teaching you that now. So for that, I'll just give you one table. So I'll just so what are all those things I'll be telling you now. So we'll go with that now. In that, the very first condition I have, that is expected rent to be adopted as GAV. So whatever the expected rent is there, so that expected rent we are going to adopt here that as a GAV, gross annual value. In the same way, whatever municipal tax is actually paid, usually that usually goes under a deduction, and both the deductions here under section 24 will be permissible here for the deemed to be a let out property. Okay, so these are the things you have to know in deemed to be a let out property. Is there any doubts in this? Okay, so hope there is no doubt in this. So now I think I can go with the next part of your theory. So after deemed to be a let out property, so then we have the deemed ownership. So we'll go with that concept. Before that, I'll just take a screenshot of this. Okay. Yeah. So the next thing that I'll go over here is regarding the arrears of interest. Usually the arrears of interest, if I wanted to tell you, so that usually comes under section 25A. So you have to know the section. I'll just tell you the sections of this. Arrears of rent and unrealized rent receipt and unrealized rent receipt subsequently. Okay, so this usually we studied under section 25A. According to this section, so what do we tell? Just a second, guys. Okay, sorry, I was having some network issue. And just again share my screen. Okay, probably the screen is visible to you. So I was talking about your arrears of rent and unrealized rent receipt. So all those things will be coming under your section 25A. So that according to that section, we usually give a deduction of 30% on the same thing, the same deduction amount will be giving it over that. Okay. So now I think